So now let us start with Essay 320, Materiality in Planning and Performing the Audit. So before getting into the main part of the essay, let us understand some basic definitions. So first and foremost, let us understand what is the meaning of material. For example, you have 1 rupee from today and 1 lakh from today. Okay, so today you have 1 rupee and 1 lakh. Which of these is material? 1 lakh is obviously material because the value is more. Now, if you have 10 rupees from 1923 and 10 rupees ordinary note today, so which of these is material? So the 10 rupees from 1923 is considered as material because you cannot find more of them today. Its value is high. So there are people who collect old coins, especially those dating back to 1920s, 1930s, like that. So their value is more. Why is their value more? See, you can obviously mint 10 rupee notes more today, but you cannot mint the 10 rupee note from 1923 today. So this is more material. So next let us understand what is the meaning of misstatement. So misstatement is the difference between amount, classification, presentation and disclosure of a reported financial statement item and the amount, classification, presentation, disclosure of a financial statement item that is required to be reported in accordance with applicable financial reporting framework. So basically it is a difference between what you reported and what you are required to be reported. So for example, inventory. So inventory should be valued at cost or NRV, whichever is lower, we all know that. Now the cost of the inventory is 10 lakhs and the NRV is 9 lakhs. So it should be valued at 9 lakhs, but the company valued it at 10 lakhs. And so the company has reported 10 lakhs, but what should have required to be reported? 9 lakhs. So basically there is a misstatement of rupees 1 lakh over here. So that is the meaning of misstatement. Now when is a misstatement considered to be material? So misstatements including omissions are considered to be material when they individually or in aggregate can influence economic decisions of the users of the financial statements. If a misstatement or omission individually or in aggregate, it is affecting the economic decisions of the users taken on the basis of financial statements, then the misstatement is considered as material. Okay, so remember this definition very nicely. You have to quote this misstatement material definition again and again in this particular standard. Now what is the objective of the auditor in this particular standard? So the objective of the auditor is to obtain reasonable assurance that the financial statements as a whole, the entire financial statements as a whole, are free from material misstatement. The material misstatement can be either due to fraud or error. Okay, so he's going to obtain reasonable assurance the financial statements are free from material misstatement, which will ultimately enable the auditor to express an opinion on the financial statements. What is the main objective of the auditor? He has to express an opinion on the financial statements, and for that he has to obtain reasonable assurance that the financial statements are free from material misstatement. Okay, he has to express an opinion stating that financial statements are prepared in all material respects and as per applicable financial reporting framework. Now here is an important thing. Now what materiality is not always a matter of relative size. Okay, so materiality doesn't always indicate that the size, for example, the amount of the transaction is about 10 lakhs, let us consider it as material. So that is, the materiality is not always a matter of relative size. For example, a small amount lost by fraudulent practices of certain employees can indicate a serious flaw in the enterprise internal control system requiring immediate attention to avoid greater loss in the future. So what does this mean? For example, there is a small boy in the house. He has a habit of taking 1 rupee or 2 rupee coins from his parents' purse or wallet. Okay, so right now he has a habit of taking 1 rupee or 2 rupee. But if you don't correct it right now, later he will pick up 10,000 rupees, 1,000 rupees, 500 rupees notes. He will pick up a bigger amount. So now you are thinking that it is a small amount that is lost, but later that small amount will only become a bigger amount. So small amount by fraudulent practices of certain employees can indicate serious flaw in the enterprise internal control system. So this small amount is getting lost because there is a flaw in your internal control system. Okay, so that is the meaning of C. So this particular concept has also been tested in the form of an MCQ. Which of the following is true regarding materiality? It is unaffected by nature of an item. False. It is unaffected by requirements of law or regulation. False. It is not a matter of professional judgment. See, materiality is always a matter of professional judgment, which we'll discuss in the later part of this standard. It is not always a matter of relative size. Yeah, this thing is true. Now, in this particular standard, So what is the responsibility of the auditor? So in every standard, the responsibility of the auditor is very, very important. So here, the responsibility of the auditor is to apply the concept of materiality in planning and performing the audit. So right from the planning stage itself, you have to apply the concept of materiality, and throughout the performance of audit, you have to apply the materiality concept. So materiality is a concept in auditing that deals with the significance of transactions, balances or errors. So it is a threshold above which misstatements or omissions could influence the economic decisions of the users of financial statements. So basically, it is a threshold above which whatever misstatements occur, these misstatements which occur above the threshold are going to affect the economic decisions of the users of the financial statements. So it is basically a threshold above which whatever misstatements occur, which will affect the economic decisions of the users. So financial reporting framework discusses materiality in context of preparation and presentation of financial statements. So FRF specifically discusses materiality in context of preparation and presentation of financial statements. So such a discussion, if present in the applicable financial reporting framework, it provides a frame of reference to the auditor in determining materiality for the audit. So if such a discussion regarding materiality is present in context of preparation and presentation of financial statements, then that will act as a frame of reference in determining materiality for the audit. See, auditor doesn't know anything about materiality, but he will use this discussion. If the discussion is present, he will use this as a frame of reference to determine the materiality level. But if the financial reporting framework does not include a discussion of the concept of materiality in context of PPFS, then these characteristics which are listed below will provide the auditor a frame of reference. If the discussion is there in context of PPFS, then the auditor will use that. But if no such discussion is there, then the auditor will use these characteristics as a frame of reference. So what are those characteristics? So misstatement including omissions can be considered material if they individually or in aggregate could reasonably be expected to influence the economic decisions of the users taken on the basis of financial statements. So basically, if a misstatement or an omission, which individually or in aggregate, if it is reasonably expected to influence the economic decisions of the users, then in that case it will be considered as material. Next, judgment regarding materiality are affected by surrounding circumstances, size and nature of metal misstatement, or combination of both. So while setting this materiality threshold level, the auditor needs to exercise his professional judgment. So this judgment regarding materiality is mainly affected by the surrounding circumstances, the size and nature of the metal misstatement, or a combination of both. Judgment regarding materiality of a matter is also dependent on common financial information need of the users as a group. So whatever judgment regarding materiality is there, it is also dependent on the common financial information need of the users as a group. Okay, so जितने भी users हैं, users of financial information, so उनके ऊपर भी ये dependent है. So basically यहाँ पर अगर आपके पास discussion है in context of preparation presentation of financial statements, then the auditor will use that as a frame of reference. If no such discussion is there, then in that case these three general points will be used as a frame of reference for setting the materiality threshold level. Okay, next, so in planning the audit, the auditor makes judgments about size of misstatements that will be considered as material. So in the planning stage only, you will start making judgments. The auditor will start exercising his professional judgment about what size of misstatements will be considered as material. Now, these judgments, whatever the auditor is making, they will provide a basis for determining the nature, extent and timing of risk assessment procedures, identifying and assessing risk of metal misstatement, and also nature, extent and timing of further audit procedures. So you can remember it like this: NET of FAP, identifying and assessing risk of metal misstatement. So whatever the materiality that is determined while planning the audit, it does not necessarily establish an amount below which uncorrected misstatements individually or in aggregate will always be evaluated as immaterial. So this can be tested in a true or false statement. Okay, so just because you have in the planning stage you have determined this level, it doesn't mean that whatever misstatements occur below this level are considered as immaterial. So there are circumstances in which the auditor will have to evaluate them as material even if they are below materiality. So although it is not practicable to design audit procedures to detect misstatements that could be material solely because of their nature, the auditor considers not only the size but also the nature of uncorrected misstatements. So basically, he will not only consider the size. Size means above the threshold, whatever misstatement is there, it is material. He will also check the nature. Okay, he will also check the nature of the uncorrected misstatements and particular circumstances. So basically, depending upon the nature of the transaction, depending upon the particular circumstances, even below the materiality threshold limit, whatever misstatements occur, they might be considered as material. Now this solely depends upon the auditor's professional judgment in different circumstances. So auditor's professional judgment is mainly used to detect materiality, to determine materiality, to choose appropriate benchmark, and to determine appropriate level of benchmark. Okay, so auditor's professional judgment is mainly important in these three cases. In these three cases, the auditor has to exercise his professional judgment. So while judging materiality, the significance of an item has to be viewed from different perspectives. So materiality of an item may be judged by considering the impact on profit and loss, balance sheet, and total of the category of expenditure or income to which it pertains, and on its comparison with the corresponding figure of the previous year. So he has to check the materiality in respect of materiality of an item. So basically उस item में misstatement है, इस statement की वजह से प्रॉफिट एंड लॉस अकाउंट में क्या इम्पैक्ट है, बैलेंस शीट में क्या इम्पैक्ट है, एक्सपेंडिचर में क्या इम्पैक्ट है, इनकम में क्या इम्पैक्ट है, ओवरऑल बेसिस में क्या इम्पैक्ट है, एंड ही विल ऑल्सो कंपेयर इट विद द प्रीवियस ईयर स्टेटमेंट्स, प्रीवियस ईयर फिगर्स. सो बेसिकली व्हेन जजिंग मटीरियलिटी, सिग्निफिकेंस ऑफ एन आइटम हैज़ टू बी व्यूड फ्रॉम डिफरेंट पर्सपेक्टिव्स. अलग अलग तरीके से आपको इस मटीरियलिटी को एनालाइज करना है, देखना है, कंपेयर करना है. So if there is statutory requirement of disclosure, it is to be considered material irrespective of value of amount. So in some cases what happens is that there are statutory requirements that you have to disclose. In that case, even if the amount is immaterial, you are supposed to disclose. Okay. For example, as per division 1 of schedule 3, any item of income or expenditure which exceeds 1% of the revenue from operations or 1 lakh, whichever is higher, needs to be disclosed. So basically अगर कोई भी इनकम या फिर एक्सपेंडिचर 1% ऑफ रेवेन्यू फ्रॉम ऑपरेशन या फिर 1 लाख रुपीज़, इन दोनों में से हायर अमाउंट से भी ज़्यादा है, देन इन दैट केस यू हैव टू डिस्क्लोज इट. देयर इज नो ऑप्शन. A company should disclose in notes to accounts shares in the company held by each shareholder holding more than 5% shares, specifying the number of shares held as per requirements. So basically, if there is one shareholder and his holding is more than 5% of the total shares, then it has to be disclosed as per the statutory requirements, even if the amount is immaterial. Okay, even if the amount is below the materiality threshold. So these are in case of statutory requirements. So the determination of materiality is a matter of professional judgment. So the auditor has to exercise his professional judgment when he is determining the materiality level. So this determination of materiality is basically affected by the auditor's perception of financial information needs of users. So basically, why are the financial statements being audited? So that the users will get a nice set of information which doesn't have errors or which does minimal errors. So the determination of materiality is affected by auditor's perception of financial information needs of users. So the auditor will generally assume a few things, that the users will have reasonable knowledge of business, economic activities and accounting. So whoever users of financial statements are there, he will assume that they have reasonable knowledge about the business, the economic activities and the accounting, and they have a willingness to study the information in the financial statements with reasonable diligence. Okay, and he will also assume that the users understand financial statements are prepared, presented and audited to all levels of materiality, So this is the second assumption. The third assumption that the auditor will have is that he thinks that the users recognize the uncertainties inherent in the measurement of amounts based on use of estimates, judgment and consideration of future events. So basically, measurement of amounts. So when you're measuring amounts by using estimates or judgments or consideration of future events, they are not always perfect. There are uncertainties inherent in them. So he also assumes that the users recognize these inherent uncertainties also. Next, the users make reasonable economic decisions on the basis of information in the financial statements. So he thinks that on the basis of the information in the financial statements, the users will make reasonable economic decisions. So these are a few things that the auditor assumes users do possess. Next, so the next concept is performance materiality. So before reading this concept, let us understand what is performance materiality with the help of an example. But even before understanding performance materiality, let us understand what is total materiality, overall materiality. For example, an auditor might set overall materiality at 5% of pre-tax income. For example, a company is having 100 crore worth pre-tax income. Then what is the materiality level? 5 crores. So the materiality threshold will be 5 crores. So this is the overall materiality. So it is for the financial statements as a whole. Now, what is specific materiality? So in some cases, what happens is that a company might have a few important areas. So for those important areas, a specific threshold can be set. For example, an Indian manufacturing company. For an Indian manufacturing company, cash and inventory might be particularly important. For that manufacturing company, its most important areas are cash and inventory. Then the auditor might set a specific lower materiality for these accounts. So apart from the overall materiality, for these areas, he will set a lower materiality level because these areas are particularly important. For example, for cash, he might set 1 crore. For inventory, he might set 2 crore, which is lower than their overall materiality. Okay. So this is about overall materiality and specific materiality. Now let us understand performance materiality. Now, these are your financial statement items. So in financial statement items, we have debtors, plant and machinery, stock, and there are many more items. I wrote just a few. So your overall materiality threshold over here, assume it as 10 lakhs. So above 10 lakhs, whatever misstatements will occur, they will be considered as material for the entire financial statements. So now let us look at what all misstatement is there in each one of these. In debtors, the misstatement is 4 lakhs. Okay, so when you look at debtors, the misstatement is 4 lakhs. It is lower than 10 lakhs, so it is immaterial. So we will assume it like that. Then you look at stock. In stock, what the misstatement is 5 lakhs. When you look at stock, the misstatement is 5 lakhs, which is less than 10 lakhs. We'll assume it as immaterial. Like that, there are many items in financial statement. There are so many items. When you look at each one of them, you will think that it is immaterial. But when you mix, when you total all of them and see, you will understand that it is exceeding the overall threshold limit. So by the time the auditor has realized this, already the damage has been done. So what the auditor will do is that he will set a lower level. So this is the overall materiality level, 1 lakh, 10 lakhs. So he will set a performance materiality level 7 lakhs. So as the misstatements are cornering towards 7 lakhs, the total 7 lakhs, he will start doing more checking. So what happens over here is that performance materiality level is basically set to reduce the probability that the aggregate uncorrected or undetected misstatements is exceeding the materiality level. So whatever your total uncorrected, undetected misstatements are there, they exceed the materiality level. To reduce that probability, auditor is setting up performance materiality. So let us read it so you will understand it better. So practically, it is difficult for auditors to design tests to identify individual material misstatements. Individually, you can't keep on identify each and everything. So it is likely that misstatements are material in aggregate. Individually, when you look at them, nothing is going wrong. When you look at them as a whole, there is a misstatement. There is a material misstatement in aggregate. So it takes us to the concept of performance materiality. So performance materiality means the amount or amounts set by the auditor at less than the materiality for the financial statements as a whole. So what is the difference between that specific materiality and performance materiality? In specific materiality, you are setting the lower amount for specific areas. But in this case, you are setting a lower amount for the financial statements as a whole. So your 10 lakhs is your overall materiality. But below that, you are setting a limit, 7 lakhs, which is for your financial statements as a whole. But in case of that specific materiality, what you did is that here you set a limit which is lower than your overall materiality, but it is for specific areas like for cash and inventory. Performance materiality is a lower limit that is set for the financial statements as a whole. To reduce to an appropriately low level the probability that aggregate of uncorrected and undetected misstatements exceed materiality for the financial statements as a whole. So you want to reduce the probability that these misstatements are exceeding the aggregate. These aggregate misstatements are exceeding the overall materiality. Okay, so if applicable, performance materiality also refers to the amount or amounts set by the auditor at less than materiality level or levels of particular class of transactions. So in some cases, whatever materiality level that is set for particular class of transactions lower than this thing is also considered as performance materiality in some cases. It will also refer to that. So what do you call this? This specific materiality and performance materiality sometimes can be very similar. Okay. Next, performance materiality is set at a value lower than the overall materiality. It lowers the risk that auditor will not be able to identify misstatements that are material when added together. So basically, it is reducing your risk. So performance materiality will basically ensure that your risk is reduced. So it is a value lower than overall materiality. Overall materiality 10 lakhs, performance materiality 7 lakhs. Now, determining materiality and performance materiality when planning the audit. So when establishing the overall audit strategy, when you are establishing your strategy, you will determine materiality for the financial statements as a whole. Okay, when you are devising a strategy, at that stage you will establish a materiality level for the financial statements as a whole. But in specific circumstances, there is one or more particular class of transactions, account balance, or disclosures for which misstatements of lesser amounts in the materiality for the materiality for the financial statements as a whole could reasonably be expected to influence the economic decisions. Even if the misstatement is below that level, it will still be impacting the economic decisions of the users. So what did we read over here? We read that even if the misstatement is below the threshold, still it can impact the user's decisions. So basically that point is again written over here. So the auditor shall also determine the materiality level or levels to be applied to those particular class of transactions, account balances, or disclosures. So basically he is determining a performance materiality level for particular classes of transactions as well. One more important thing over here. This can be tested in the form of an MCQ. So in areas where the risk of metal misstatement is high, the risk is very high, then in that case your performance materiality level will be low. Your actual materiality, that is your overall materiality level, is 10 lakhs. But here the performance materiality level will be set to 4 lakhs. Because the risk is high, you're setting a lower level. But if the risk of misstatement is low, then your performance materiality level will be high. Why high? Because already the risk is low, so you can set a higher performance materiality level. So this was about performance materiality.